Monday, January 29th, 2018. Monaco 64, home of alternative economics and contrarian views. Early market update and a close look at the bond market, specifically U.S. Treasuries and yields. So it's 7:30 a.m. London or 2:30 a.m. Eastern Standard Time. And I have told the viewers in the past that I would cover the bond market if I felt that something, some kind of warning was needed. I did work in the bond markets for over 20 years, so that's my core expertise is interest rates in bonds, and of course bond prices move inversely to bond yields. So when bond yields go up, it's not a good thing for the markets, and bond prices go down. And why is it a bad thing for the markets? Well, because higher Treasury yields means the U.S. government is going to be every basis point higher in Treasuries means that the U.S. government bill for paying interest on those bonds goes up, and also the bill for issuing new debt goes up. The bill for rolling over old debt goes up, and the U.S. government always rolls over debt. I think you have to go back over 150 years. I think Andrew Jackson was the last administration in the U.S. when the government debt was paid off. So every rise in basis points is a bad thing, and U.S. Treasury yields are considered a risk-free rate of return because the U.S. government has the power to always print dollars through the Federal Reserve to pay off its creditors. Does it mean that those dollars are going to be worth as much as they were when people lent the money originally? No, because that's what inflation is. The more supply of something versus other goods and services, the more worthless that things become. It's natural. It's the law of supply and demand. Central banks, the Fed included, have tried to keep that law of supply and demand at bay and manipulate prices of bonds and every other financial asset. But it looks like right now they might be losing that game. So before I go further, let's just quickly check what's going on this morning. Spot gold. Late last night, I checked when we opened around 11 p.m. London. Gold was actually doing fairly well. It managed to open above 1350 and go up to 1350-270, which was a good sign. Usually early on the session on Sunday night, there's a susceptibility for the bullion banks and the powers that be to smash gold down. Gold has come off though. We're now 1347.30, down $2.20. The range has been 1350-270 to 1346.28. So the suspects are back in London, I guess. The banks, it's 7:30, but they're London starts early. They start around 7 a.m. Spot silver down 5 at 1734. So yeah, we're down a little bit, but we're not getting hammered. The Dow futures up 46, 26,657. S&P up 1.25 point. The Nasdaq is basically unchanged. I really think investors are very, very complacent. The central banks have had their back for many years, since 2009, and they never expect anything bad in the stock market, and it's just amazing. It could go higher, but is it somewhere you want to really be? Will you know when it's time to get out? Will we get 22% drop like we did in October of 1987, that would be equivalent to 5,000 points today. You know, you could have that in one day. It could really be something that takes the, you know, just destroys the market. But anyway, it's still there. You know, the stock market's still hanging on. Today, in the currency wise, we're seeing the dollar index rebound a little bit. We're at 89.13, so up a tenth, just over a tenth of a percent. We closed last week at 89.01, so up slightly. The low was 88.43. Dollar index not looking good at all, in my opinion. We've broken some very key technical levels. We've broken key retracement levels. And that's why I wanted to cover the bond markets today, because we're starting to see a bit of a move higher in the 10-year yield, which means bond prices are going down, and cost of financing for the government. And don't forget, the Treasuries are the benchmark for the rest of the bond market. Bond markets are a $200 trillion market. Stock markets are a $90 trillion market, if I'm not mistaken. Might not be the exact numbers, but the proportion is very, very much larger. The bond market is huge. Interest rates, yeah, Treasuries are the benchmark for other bonds, like other government bonds for other countries, benchmarks for corporate bonds, benchmark for high yield bonds, which is basically a euphemism for junk bonds, benchmark for mortgage-backed securities, which are bonds on mortgages, benchmarks for state government bonds, for everything. So it's very important. And don't forget that the biggest foreign owners are the Chinese, with over $1 trillion worth of treasuries. So this morning, the 10-year yield is up 4 basis points, which is significant, and we are at the highest we've been in, well, in over a year. We're at 270. So that's the highest this year, the highest in probably a year and a half, I'd say. We've definitely broken through the 2.63 level I've been talking about. We broke through that level last week. We kind of went up to 266, came down to 262, 263, and this morning we're a lot higher. So let me tell you, the last time we were here around 270 was April, April 2014. So it's actually almost 4 years, you know, since we've been at this level. The key level now, I would say, is before 3%, which is a really important level, we're probably looking at 275, 2 3/4. And the reason for that is that the bond markets look at numbers like 2 1/4, 2 1/2, 2 3/4. So 275 I expect to be a key resistance level. And also looking at the 10-year futures, the nearby month chart on bar chart, for example, the chart looks almost like the dollar index. It looks very bearish. We've broken, let's see, we're breaking now almost, in terms of the futures, we're breaking almost 7-year lows. We're just on it right now. And so I think there's a lot of complacency out there. The general public is being kept in the dark, mainly because when you watch the mainstream media like Bloomberg, maybe not Bloomberg so much, but CNBC, Fox Business, I don't watch those anymore. But if the Dow is up, that's what they talk about. Are they going to talk about the 10-year yield and bond markets? No, I don't think so, even though the bond markets are the biggest asset class out there. So right now, yeah, I think there's a lot of complacency, and we need to keep an eye on the yields, 10-year yields in general as well. Other part of other sectors of the U.S. Treasury curve are going up as well. For example, the 2-year yield now is at 2.14, the 2-year note yield. The 5-year is at 2.51. And the curve is also inverting, kind of flattening, which is a sign that the economy is not doing too well. So we're up about 30 basis points in the last month in the 10-year yield. So we've gone from 240 to 270, and that's a big move. As for gold and silver, yes, very frustrating, but I think they're not going to be able to keep this game going for much longer because they need the physical, and we know that the Western central banks have not been accumulating physical gold. If anything, they've been selling it, and they still claim to have thousands of tons, but are those thousands of tons, have they been leased out? We don't know. The people with the gold are the Chinese and the Russians, the physical gold. Yeah, that's it for now. Just a simple look at the markets and a look at treasuries and how important they are and how we need to keep an eye on them. So if you enjoyed this video, please like, share it, subscribe to my YouTube channel if you haven't yet, and also follow me on steemit.com, which is a blockchain social media platform based on the blockchain, and I think it's the future of social media. It's still early days there, but it's a very interesting platform. And you can follow me on Twitter as well. And I'll talk to you later. Bye.